Question number 1. Whenever you see a bigger question, the suggestion is to either skip, do smaller question first, and if you have done all these smaller questions like these, let's say, like this, once you are done with the smaller mid-sized questions, you should take on the bigger question at the end so as to be able to perform well on the test. Do not get logged on with the longer questions. They will waste your time and they will demoralize you. They will make you anxious. Try to remain as much composed as possible. So let's say we have to move sequentially for recording purpose. But on the exam, it's recommended that you should do smaller questions first, all of them, and then go for the bigger kill. Based on the above information, select the strategy that should be the most beneficial for saving. This basically question involves ratio analysis. Let's see what the question is all about. Marble Saving Bank has received loan applications from 3 companies in the auto parts manufacturing business and currently has the funds to grant only to one of these requests. Specific data shown below has been selected from these applicants for review and comparison with the industry average. So these are the 3 applicants, 1, 2, 3, and this is the industry average. So as far as the sale is concerned, average sale in industry is 4.3. Sonex is performing best in sales. Net profit margin is the highest for Sonex. Current ratio is also the highest for Neutron. Return on assets mean profit number. This is the best for Neutron. Debt to equity ratio, which is the measure of leverage. These ratios are specifically more relevant for banking institutions, those who want to lend you money. So debt to equity ratio, it is the lowest for Neutron. Financial leverage, lower the better. So these are the 2 specific ratios which creditors and financial institutions, lenders are most interested in. So for these 3, Neutron appears to be the best. Now, based on the information above, select the strategy that should be most beneficial to Marble Saving. Look for the company that has the lowest leverage, lowest debt to equity ratio. So let's see the options. Marble Saving Banks should not grant any loan to, as none of these companies represents a good credit risk. This is performing better than industry. Marble Saving Bank should grant the loan to Bailey as all of the company's data approximate industry average. We are not looking for the one that approximates industry average. We are more interested the one that is beating the industry average, performing better than the industry. Marble Saving Bank should grant the loan to Neutron as both the debt to equity and degree of financial leverage is below industry average and least amongst all. So these are the 2 ratios a bank is most interested in. So the loan should be sanctioned or granted to Neutron. Okay, this questions involve basic earning per share. Good question indeed. Your LOS requires you to be able to calculate earning per share. Diluted earning per share is not a part of your exam. So many students have written the exam and all of them were tested on earning per share. If there was 1 or 2 students over the last 10 or 12 years, they have reported that DPS was there, but it was very basic. So I'm going to solve this question for basic earning per share as well as for diluted, so you know what is the difference between these 2 and how we can calculate diluted. It's very simple. So here first we need to find out the basic earning per share. The formula for basic earning per share is the income available to common stockholders, sometimes called net income minus preferred stock dividend, divided by the weighted average number of shares. This is how we calculate the basic earning per share. And then we will go for diluted earning per share. Let's say right here. We'll do it later. Let us first find basic earning per share. For the year just ended, ABC had net income of 5.3 million. Okay, net income is already given, 5.3 million. It says 5.5 million of 7% convertible bonds were issued in the prior year. Convertible bond is a subject of diluted earning per share. They have no implication on basic earning per share. I'm going to skip it. It further says 50,000 shares of 10% cumulative preferred stock with a par value of 100 were issued in the prior year. Preferred stock dividends were not declared in the current year, but were current at the end of the prior year. Remember, whenever you're calculating basic earning per share, and if you have preferred stock outstanding, and if they are cumulative, whether the directors have declared the preferred stock dividend or they did not declare the preferred stock dividend, for basic earning per share calculation, you must calculate the preferred stock dividend, whether declared or not declared. So what you will do, you will take the amount 50,000 shares preferred stock of 100 each, and the preferred stock dividend percentage is 10%. So multiply 50,000 with 100 times 10%. So that will give you $500,000. So this $500,000 is preferred stock dividend, not declared, but we will have to deduct in any way. Done. Next, we need to calculate the weighted average number of shares. At the beginning of the current year, 1.06 shares of common stock were outstanding from January of the start of this year. On June 1st, 60,000 more shares were issued and sold, and tax rate is 40%. Now, how do you calculate the weighted average? These shares remain outstanding till the end of May, Jan, Feb, March, April, May. So this number, ladies and gentlemen, has a weight of 5 out of 12, because these shares remain outstanding for 5 months out of 12, right? Then company issued 60,000 more shares. Now the new number of shares is 1.06 million plus 60,000, which will be 1060 plus 60. The new number of share becomes out to be 1120,000. Please remember, 1060 shares were outstanding from Jan, Feb, March, April, May, 5 months out of 12. 60,000 shares were issued, which made a total number 60 plus 1060 as 1120,000, and this number stayed outstanding from June, July, August, September, October, November, December, 7 months out of 12. So what you're going to do, 1060 times 5 by 12 and 1120 multiplied by 7 by 12, right? So this will give you the weighted average number. If you do, this number would be equal to 441667, and this number would be equal to 653333. So this is the weighted average number. Combining these will give you a total of 1095,000. This is the weighted average number of shares. How did I calculate? This number stayed outstanding for 5 months, 5 by 12. 60,000 issued. New number is 112,000. 20,000, that's 7 out of 12. So combining these give you weighted average. And if you do the computation, 5.3 million less 500,000 upon 109,500 gives you 4.38. 4.38 C is the answer. So this is the basic earning per share. Let us say if we have to calculate the diluted earning per share, how would you do it? For this, you take net income minus preferred stock dividend plus interest multiplied by 1 minus tax rate. And if you have convertible preferred stock dividend, that preferred stock dividend will be added back. If it is, remember, this is only when the preferred stock is convertible. This is added when the bonds are convertible. In the denominator value you will write the same number 1095. When these preferred stocks are converted into common shares, they will result in a certain number of common stocks. So let's say 50,000. When these convertible bonds are converted, a certain number of shares will emerge. Let's say how many they are? 10,000. So what you take, net income minus preferred stock dividend. If preferred stocks are convertible, you will add this back. PSD will be added back. If not, then cut this. If there are convertible bonds, you put interest into 1 minus tax, because when those bonds are converted, tax is no longer payable. So you save on tax. This is the tax saving. Right here, this is the complete formula. Please remember, net income minus preferred stock dividend plus interest saved in case convertible bonds plus preferred stock dividend saved in case only if the preferred stock is convertible. Otherwise, we won't have it. Like in this question, the preferred stock is not convertible. In the denominator, same number of shares will come. In here, you will have the number of shares that are convertible from bond to common stock. Number of shares convertible from preferred stock to common stock. So let us see what do we have in this question. We have net income 5.3 million. Okay. We have preferred stock dividend 500,000. Okay. Do we have convertible preferred stock? No. That's why this 500,000 will stay. We are not going to add it back. Yes. What is relevant is the interest saved. How much interest you will save? 5.57%. 5.5 million, 7% is the interest you pay every year. When these bonds are converted, this 385 interest will be saved, but it must be taken on after tax basis because all these numbers are after tax, so interest must be after tax. So 385 times 1 minus tax rate, which is 40%, will give you 231,000. 231,000. Okay. In the denominator, you have 1095,000. There are no convertible preferred stocks, 0. But look at here. 5.5 million, 7% convertible bonds were issued in the prior year at a face value of 1,000 each. Each bond is convertible into 50 shares. How many bonds are there? $5.5 million worth of bond with 1,000 bond par value. There are 5,500 bonds outstanding. Each bond will convert to 50 new shares. So 5,500 times 50. This is the new number of shares that will have to be issued. So add the numerator divided with the denominator, you will get the diluted earning per share. This is the maximum you should expect, not more. Probably less, but not more. This is a fantastic question from derivatives, options, option valuation, whether should we exercise, when should we exercise. Good question, very good question indeed. Please pay special attention to the questions requirement. Z-Flex company purchased a call option on September 30th, year 1 to buy 20,000 shares of XYZ company. Company shares over the next 45 days at an exercise price of 19.5. This is the option strike price, sometimes called the exercise price or the strike price. You can exercise the call option at 19.5. It's a beautiful question indeed. This is the strike price or exercise price. The call premium paid by Z-Flex company is 0.5 per share. You supposed to purchase 20,000 shares. You paid 0.75 premium to acquire the call option. So how much did you pay? 0.7 times 20,000. You paid $15,000 as a call premium. Call of the price you paid to acquire these options. Okay. Assuming that over the next 3 consecutive 15 days interval, stock trades of the following maximum prices were seen. What is the, so this was the price highest during day 1 to 15. This was the highest from day 16 to 30. And this was the highest from day 31 to 45. Pay very special attention to the question's specific key information. What is the earliest period, if any, earliest period? Focus is on earliest. What is the earliest period that Z-Flex would consider exercising call option? Should she exercise the call option on period 1, 2 or 3? We can't say that unless we have some numbers to support our recommendation. Let us see these 3 periods. Period 1, period 2, period 3. Our exercise price stay the same or strike price stay the same. We can exercise the call option at 19.5 in these 3 periods because exercise price is fixed. But the stock price varied over the period. Stock price period 1 highest was 19.5, 20.25 period 2. Period 3 highest was 20.45. There was no payoff here. There is a payoff here of 0.75 per share and 0.95 per share. If she decides to exercise the call option in period 1, there is no payoff in striking, but she has paid call premium of $15,000. Eventually, there is a loss of $15,000. If she decides to exercise the option in period 2, thereby, if she exercises, she will make a 0.75 gain on each call option. There are 20,000 options. That means she will make a profit of 15,000. This profit is offset against 15,000. Premium paid, the payoff is nil. In the last case, 0.95 is the difference between strike price and the stock price, which means she can make a gain of 19,000, which will be offset partially by 15,000 premium paid. She makes a nice $4,000 profit gain. Now, if you are looking specifically for the highest gain, that's where you should exercise the call option. But when she says what is the earliest period, she would consider exercising the call option. The earliest period is going to be period 2, because in this period she makes no profit nor loss. This is the earliest period, not P1, because if this period she takes the decision, she will incur a loss. Here there is no loss. Here there is a gain, but you are delaying. So the point here is that if you exercise in period 2, this is the earliest period and there is no loss. If you're looking for the highest profit, exercise in period 3. So here your answer will be period 2, because you want to exercise in the earliest possible period without incurring any loss. And if you want to go for the highest gain, exercise it in the period 3. I hope you made sense out of it. It's a beautiful question. Please try to absorb and make sense out of it. Risk responses. If you face a risk, there are 5 possible responses you can take. You can khalli wali the risk, avoid. You can reduce the risk by taking some step, risk mitigation. You can share the risk by taking an insurance cover. Or you may go for, okay, we'll see. Let's see, acceptance. And the 5th one is called the risk exploitation. You deliberately look for risk. You are a dangerous guy. You look for the risks you see. So let us see what is the risk response in the given question. Able Corporation owns numerous businesses along the coast of Florida. The company's management has identified business interruptions events as a potential risk resulting from storm damage caused by hurricanes. Florida is a coastal area, so there are frequent storms. The company elects to treat the potential damage from the hurricanes as a part of business model. No problem. If there are hurricanes, we'll face it. So they have decided to take the risk head on. They are going to accept the risk. Absolutely knife D acceptance. It's not avoidance. They are not taking any precautions, no risk mitigation, no insurance cover. They are going to say, okay, we will see what happens. This is risk acceptance. You are going to face the risk head on and you're going to absorb it yourself. So that makes D to be the correct option. This is a very good question on marginal analysis, specifically focusing on the topic sell as is or process further. Should we sell our product as is or should we process it further? Our company currently has 4-stage manufacturing process. Goods move from processing to smoothing, from smoothing to shaping, space shaping to painting. So at which stage should we sell? That's the decision we have to make. So this is the point called sell as is or process further. Yep. Processing, smoothing, shaping and painting. We will compare the benefit at each stage with the cost at each stage to see what is the net payoff. So the selling price at processing stage is $10, the cost is 8, so means you save 2. At smoothing stage, the selling price goes to 12, cost takes a jump from 819, payoff is 3. Then from next smoothing to shaping, your selling price goes up to 12 to 18, 9, 5, 14. So payoff is 4. In the last stage where the selling price is 20, your cost jumps from 14 plus 3, 17. The payoff is 3. So the question was selling the output after which of the following stages will yield the greatest contribution. Here the contribution per unit is the greatest. So this is the stage where you should decide to sell because it gives you the highest gap between the selling price and the cost, $4. So that means shaping is the point where we should the product as is and do not process further. Okay, moving on to the next question. Okay, this question looks like more related to profitability analysis, most likely. We mean selling price and variable cost. So clearly we're talking about profitability analysis, so maybe break-even analysis. Alger company produces valves for plumbing industry. Alger's per unit sales price is given as 12 variable cost. 8 means contribution per unit is $4. That is the unit contribution margin. Alger's practical plant capacity is 40,000 units. Okay. Alger's total fixed costs 48,000 and it has a 40% effective tax rate, the maximum net profit Alger can earn. We can generate a contribution of $4 per unit, and by selling 40,000 units, our total contribution is going to be 40,000 for 160. This is the total contribution we can earn, and from this contribution we must deduct fixed cost to find operating profit. 160 less 48 gave us operating profit, from which we have to pay tax. Operating profit is 160 less 48, 112. Now pay tax at the rate of 40. 112, 40%, that is going to be 44,800. And after tax, what you get is called your net income, and that's what we need. 112 less 44,800, 67,200, and that makes B to be the correct option. Naif, absolutely right. Zishani got it right. Khizar, you got it right as well. Now this is what we are talking. This is indeed a fantastic question on Forex transactions. Please pay very special attention to this question, especially the entries, and see how the gain and loss is recorded on foreign currency transactions, not translation, transactions. Listen. It says Tough Incorporated, a US company, imported goods for 50,000 euros on December 10th, year 1. 50,000 euros, and your currency where you keep your accounting records are dollars. Importation is in euros. You bought on 10th of December year 1 and paid for them on 10th of January year 2. The following exchange rates were applicable in year 1 and 2. Please remember, you would have gone through the textbook. First is the transaction date. Second is the balance sheet date when the transaction has not been settled. And then third is the ultimate payment date. So what approximate gain or loss will Stuff book at the year end? So we're talking about only at this point, not the settlement date, but we are going to do it one step further. What will happen when the transaction is eventually settled? So I'm going to make entry for all these 3 dates. First is the date of purchase, that is the 10th of December, year 1. Then the balance sheet date, we have to consider any gain and loss, year 1. And third is the settlement date, that is the 10th of January, year 2. Since the amount is in euros, we have to pay in dollars and we have to book it in dollars also. So let us convert these and at these exchange rates. So what you will do, convert this 50,000 euros into dollars. This 0.79 euros can be rewritten as 1 over 0.79. This will give figures in dollars per euro. So 1 divided by, this will be helpful. You can do it the way it is given already. So this is the rate I'm going to use to convert this euros into dollars. So it's going to be $1.26 per euro. Second, 1 divided by 0.82, it's 1 over 1 of 0.82, that will be $1.22 per euro. And 1 divided by 0.75, that will be $1.33 per euro. Now, you can convert this. Your original liability was 50,000 euros multiplied by 1.26 means this is the amount at which you recorded your liability. But on the balance sheet date, rate changed. 50,000 to 1.22, it becomes $61,000. This is in dollars, reporting currency. And 50,000 to 1.33, it becomes 66,500. So these are the 3 amounts of our liability. This is the original reported amount. The entry we are going to make is debit purchases with 63,500, credit accounts payable 63,500. This is the reported liability. But on the balance sheet date, your liability fell from 63,500 to 61. This gap is the gain which some of you have given there. So you are going to reduce your liability by 63,500 less 61,000, 2,500. Accounts payable debit 2,500 and 2,500 credit to Forex transaction gain. This is a transaction gain, not translation. It's a part of your income from continuing operations. So Forex transaction gain is 2500. And that's the answer. But we will go one step ahead because he asked for the year end. This is the answer. See, click and move to the next question. But let us just move on to the settlement date. On the settlement date, the liability was 66,500. This is what we paid out of our cash, 66,500. Account payable stood at 61,000 because we loaded by recognizing a gain. So accounts payable is debited by 61,000. The difference, which is quite significant, 5,500, is now the loss to be reported on 10th of January. This is the Forex transaction loss. This is the loss to be reported on 10th. But your question required you only to calculate the gain at the balance sheet date. That was the answer. So I hope you would have made the sense that these three different dates, three different transactions, and this is gain loss is considered. Okay, next. This question involves demand supply diagram. Okay, so let us draw and then I will explain the idea. The question says, an increase in the demand and supply for a product will cause which of the following? Let me show you. Just elementary economics, no big deal. This is your demand curve. And let's say this is your supply curve. When the word increases, when you said increase or decrease the demand curve or supply curve, they will change their positions. If the demand curve increases, if the demand increases, it means the new position of the demand curve is going to be here. This is D1. It further says supply also increases. Increase in supply would be here. This is also called the shift outward or shift to the right, or sometimes shown this way. Right? So what has happened? Our supply and demand, they have both increased. They have both shifted to the right. They have both shifted outwards. So what was the situation? What was the original equilibrium point? Let me write it down. This was the original equilibrium quantity. This was the original equilibrium price. Because of increase in demand and increase in supply, both curves have moved outwards. Result, what we can see for sure that quantity has increased. Quantity 1 clearly is greater than the quantity at equilibrium, but we are not sure about the price. It's just that I've drawn this roughly. Price could go up, price could go down. So we are not sure about the change in price when the demand or supply increases. But what is for sure that quantity would clearly increase when the demand and supply both increase. So which can be concluded? The equilibrium quantity will increase? Absolutely, yes, you can see. The equilibrium quantity remain unchanged? No. The equilibrium price remain unchanged? We can't say. Price can go up, price can go down depending upon whether demand increase more or whether supply increase more. And the equilibrium quantity decrease? No. Equilibrium quantity increases, and that means only one option, this. Let's say, just let us philosophize this question and discuss it a bit so as to make some sense out of it. What happens when the demand decreases and supply decreases also? In that case, the quantity will decrease, price is indeterminate. So in this case, if there is a decrease in supply, this is the new supply curve. Decrease in demand, this is the new demand curve. So you can see this was the original equilibrium quantity, it has fallen to this. So we are sure about the quantity, we are not sure about the price, it can go up and down. So this is the only conclusion we can draw, and that makes D to be the correct option. Next. Okay, this is an interesting question involving risk. Boutique Collectible Incorporated has been faced with declining sales. Sales are decreasing in its small locations in recent years. Management has set an objective of achieving sales volume at prior year levels. We want to increase our sales, but sales are declining. We want to raise it up prior to the decline, and has implemented a revised strategy that includes store closure, central warehousing, aggressive online marketing, and so on. So they are trying their best to raise their sales level higher than the prior years. Sales still continue to lag even after implementation of the new strategy. Sales are still falling, problem. and evidence mounts that the demand for boutique collectibles is in steep decline. The technique least likely to be used to identify emerging risk. This is a key term. First, you need to mark this, what exactly this key emerging risk is. Emerging risk arises when the economy and the markets, they change, business context change, the environment in which you are running, they change. So which of them is least likely? So let us see, this is it. This is it. This is a very good risk matrix, will help you understand how do you manage your or identify or manage your existing risks, new risk and emerging. Please remember, emerging risks arises when the context changes, the global economy changes, market changes, competition changes, right? So let's see what first of all we need to understand what these different techniques are. Let us first discuss these. Cognitive computing means you use large volume of data and computer model will predict what is going to happen in the future. So this cognitive computing, it helps you managing existing risk, new risk and emerging risk. Data tracking, as the term itself shows, that predicting the future occurrences based upon the past data. It doesn't involve any computerization or machine learning. So it can be helpful for existing and new types of risk the business is facing. When you say interviews, you are talking about one-on-one conversation or service with different key stakeholders. So this can help you identify, manage existing risk, emerging risks. Remember, emerging risks are global scale risks when the economy changes, when the market and the fundamental business context changes. Key indicators could be quantitative and qualitative measures that show you something is going to happen. So it's good for existing and emerging risk. Process analysis only shows how business linkages, how different activities are performed. So it's more related to managing existing and new risks. Doesn't help you manage existing emerging risk. And workshops, different departmental heads, production, marketing, sales, IT, HR, commercial, they sit together and through brainstorming session they identify what is the likely scenario in the future, new and current. So the question says the technique least likely to be used to identify emerging risk associated with changing in business context. Interviews will help. Look at this. New ideas. Key indicators will help. Workshop, cross-functional workshops, different departmental heads get together, brainstorming session will bring you something that is not easily visible. What won't help is the process analysis, existing processes, how they manage existing and new risk. They cannot cater or they cannot manage the risk that is emerging in the overall global economy, overall business context in which you are operating. So this is odd out amongst all. So that is what we were looking for. The technique least likely to be used to identify emerging risk. Again, what are emerging risks? Risks when the economy, the global context changes, the business context changes in which you are operating, right? So that's something new and you need to keep these ideas in your mind. A firm target or optimal capital structure is consistent with which of the following? Target or optimal capital structure. Minimum cost of debt. Minimum cost of debt means if this is what you're talking about, then probably equity is 90% of your investment and in the business and 10% debt. This will raise your cost of fund. Minimum cost of debt means you take little debt in your capital structure, more of equity. This means your weighted average cost of capital will go up because equity is very expensive. Minimum risk. Minimum risk means again you take little debt, more equity. But in business context, sometimes you have to take risk in order to earn higher return. Or in other words, you have to achieve an optimal capital structure. Minimum equity, just 10% equity and 90% debt, that will raise cost of capital significantly because of higher risk. Debt default could be a serious risk. So our overall idea is to not to reduce debt or just equity only. We need to mix them in such a way so as to achieve a minimum weighted average cost of capital, because this is a very key rate and it may determine the viability of many projects we might be interested in. A longer question. When you see such a question, run to the next question and come back to it later. Right? It doesn't mean you will leave. I always recommend to try your best for shorter questions. Once you're done with 40, 50 questions, this will give you the much needed confidence you need on the exam. Try to do shorter questions first. They will boost your morale and you will feel more confident. Then take on the challenging question with full force, with full confidence. So I would move to the next question and then move on. But let's see what the question is all about. This basically involves relevant cash flows. Question specifically what it says must mark what the question says when you see a longer question. The weighted average cost of capital is 10%. When comparing the two options, the 50,000 trade-in allowance would be considered. Trade-in allowance, I will explain first what is trade-in allowance. Let's say I have an older machine or an older vehicle and I want to acquire a new one which costs $100,000. The vendor says, okay, bring your old machine and let's say it's 1 million. Let's take a bigger number. Bring your old machine. I will give you a trade-in allowance of $50,000. You can buy the new machine for $950,000. This $50,000 is the agreed value of the old machine, is called the trade-in allowance, and the new machine is bought for $950,000. The question is, when comparing the two options which we will study, this $50,000 trade-in allowance, is it relevant or not? That's the question. But let us see the options first. We'll come to this later. Verla Industry is trying to decide which of the following two options to pursue. Either option will take effect on January 1st next year. Option 1, acquired new finishing machine. The cost of the finishing machine is 1 million. Useful life 5 years. Net pre-tax cash inflows arising from savings and labor costs will be 100,000 per year. Depreciation expense will be calculated using the straight line for both financial and tax purposes. An incentive to purchase. Verla will receive a trade-in allowance of 50,000 in its current fully depreciated finishing machine. This is what we're talking about. Second option, we don't buy any machine. Rather, Verla can outsource the work to LM Incorporated at a total cost of 200,000 per year for 5 years. If it outsources, Verla will scrap the current fully depreciated finishing machine for nothing. So either you purchase a new one for 1 million less 50,000 trade-in allowance, or you go for an outsourced company to get the job done. In a way, Khizr, you are right. That's the salvage value for us, 50,000. So what to do with this trade-in value? What should it be? How should it be treated? It is irrelevant because it does not affect taxes. Relevancy is determined whether it affects the cash flow or not. Taxes is not a determining factor. A cash flow is relevant or not. This is from the point of view of the cash flows, not from the point of view of taxes. So it is incorrect. This 50,000 is relevant because it decreases the cash outflow. Had we gone for outright purchase, we would have paid $1 million. This 50,000 has lowered our net payable. Thereby, it is reducing our cash outflow. It is very much relevant. B is the answer. Why not C? It is irrelevant because it does not affect cash flow. It does. It reduces your cash outflow. Relevant because it is an increase in cash outflow. It is a decrease in cash outflow. So you have a very good reason for rejecting ABD. C is your answer. Alright, next again a question you might have seen somewhere. Here we have to select which of these methods should be used to speed up our cash flows. So this question relates to cash management. We have been given lockbox. We have been given drafts, bank float, and electronic fund transfer EFT. Every decision involves certain costs and benefits, and we would like to see which of these are beneficial, and then we will select the combination. Let us do the workings. Simple. Lockbox system. The Rolling Stone Corporation and Entertainment Ticketing Service is considering the following means of speeding cash flow for the corporation. First is lockbox. This would cost $25 per month for each of its 170 branches. And it would result in interest saving of 5240. So your interest saving is first, cost later. 25 times 170, if you do the multiplication, it gives you 4250. Benefit less cost, it's 990 positive. Drafts would be used to pay for ticket refunds based on 4,000 refunds per month at a cost of 2 each. 4,000 times 2, that is the cost, $8,000, and which would result in interest savings of 6,500. Benefit is less, cost is more, so this method appears to be inappropriate. Bank float. Bank float would be used for 1 million in checks written each month. The bank would charge 2% fee for the service. 2% of 1 million, 20,000. So this is the cost. But the corporation will earn $22,000 in this arrangement. That is 2,000 net benefit. EFT, electronic funds transfer. Items over 25,000 would be electronically transferred. It is estimated 700 items of this type would be made each month at a cost of 18, which would result in increased interest earning of 14,000. So your savings is 14,000 and 18 multiplied by 700 times 12 gives you 12,600. Net 1,400 positive. So your drafts are inappropriate. Then lockbox, banking float, and electronic fund transfer, D has the right combination. So these three options are suitable because they are giving you some net benefits. Rest, the drafts is in fact loss making. Okay, before we do this question, I would first like to explain these terms and then you will tell me what we should do. Let me explain these terms and then you go for the kill yourself. When you say sell off means you are selling a portion of your company to outsiders and you give up your control. This is called sell off. A part of the company is taken, listed and sold to outsider and control is given up. This is called sell off. Spin off is different. In spin off, what we do, a part of the business is separated and shares are given to existing shareholders. It's just that it's being separated, control is still kept. Existing shareholders. This is to the outsiders. So they look same but they're different. Sell off to the outsiders. Spin off is to our own shareholders and you still hold control. You still hold control. What about tender offer? This is totally irrelevant term here. Tender offer is that let's say there's a company Ansar owns, Ansar Incorporated. And I offer Ansar, I'm going to purchase your company at $50 per share. Are you willing to sell? This is called tender offer, where I invite Ansar to sell his shares at 50 each. So this is not what we're looking for here. And what is equity carve out? Equity carve out is separating a certain portion of the company, selling them to outsiders, but only less than 50%. You still hold control. Now these are three comparative. In A, you sell to outsiders, you give up control. In B, you give shares to existing shareholders, you hold 100% control. In equity carve out, you separate a part of the company, get it listed and sell less than 50%, still hold control. So what actually we should be doing in this situation? Gerard Incorporated is a leader in the home health service industry with operations primarily in the western United States. Gerard or Gerard, whoever the hell he is, owns 100% of Brighton Greens, a company that operates nursing care facilities in the same region. Wanting to devote all of its corporate resources to home health care and hoping to generate cash, Gerard should look to divest its operation. Gerard want to khali-wali this business. So when you're khali-waliing some business, so basically you are selling off. Divestment is sell off. You are separating a part of the business and selling it to outsiders. 100% control is being given up. This is sell off, not equity carve out. In equity carve out, you sell a part of the business and you hold control. You hold management decision making. You hold focus. Here I want to get rid of this business because I want to focus more on my core business activities, more on corporate resources to be channeled in good businesses. Here the intention was to khali wali, to kick out a business on which you have no interest or expertise. So it's a sell off, people. It's a sell off. It's not equity car out, because we are completely, because this is the key word, people. This is the key word. Divest is an equivalent of khali wali. To hell with the business. We are just selling it off to someone else. They will take care of it. So people, A is the answer. Next. Billy Bob Bros are trying to determine how many car terrarium sets they would have to sell each year to break even. It's a break even question. They have determined that their fixed cost would be $5,000. This is the key piece of information in break even analysis, $5,000. Variable cost 6.5, selling price 9. These two are very important to calculate your unit contribution margin, which is 9 minus 3, 6.5, I think 3.5. Or is it 2.5? I think 2.5. 9 less 6.5, 2.5. This is your unit contribution margin, 2.5. The project is selling 1800 sets in the first year. What would be their pre-tax profit or loss for the year? It's very simple. If 2.5 is per unit contribution and 1800 units are to be sold, that will get you a contribution of $4,500. Of this contribution, when the fixed cost is paid off, you end up at a loss of $500. So there is a loss of $500, and absolutely Zishani got it right. It is B. This apparently is a very innocent looking question, but it is not. So do not take anything on the face of it. We need to find out the inventory turnover, and we know inventory turnover in number of times is equal to the cost of goods sold over average inventory. We don't have average inventory, but we can calculate by taking opening plus closing, dividing by 2, 17, 13, 30 by 2, 15,000. That is the denominator. We don't have CGS. Can we find? Yes, you can. We know CGS is equal to opening stock plus purchases minus closing stock. So that's going to be 17 plus 56 less 13 gives you 1756 less 60,000. So you have to calculate both numerator and denominator. So 60,000 upon 15, 4. Now it looks interesting. Once you have found the numerator and the denominator, that makes B to be the correct option. Okay, now this is question involving Forex, and this is a question that requires some serious thinking. We'll take some time on this question to make sure you understand the idea. Alright, so I need my pointer for this question specifically. Shore company records its transaction in US dollar because it's a US based company. A sale of goods resulted in a receivable denominated in Japanese yen. Right. Our account receivable, it is denominated in yen. We have to receive yen in the future. Alright. And it further says, and a purchase of goods resulted in payable denominated in euros. We have bought some goods and payment for these goods are to be made in euros. So interesting, our accounts payable is in euros. Okay. We have to receive yen and we have to pay euros in the future. Pay very special attention to the question like these. They must be carefully studied, carefully analyzed, and then go for the final kill. We have AR denominated in yen, AP denominated in euro. The question says, Shores recorded a foreign exchange gain on collection of receivable. There is a gain in yen-based transaction, an exchange loss on settlement of payable, and there is a loss in settlement of euros. What do you think would have happened? Since your yen was the account receivable currency, it means yen would have got appreciated against US dollar. So when you received yen, you received lots of dollars. Lots of dollars. See, this small comparative sign should help you understand symbolically. Yen appreciated over the period. Yen appreciation resulted in conversion lot of dollars. That means there was a gain. Okay, what happened here? The exchange rate resulted in a loss in euro. That means euro would have appreciated as well, and you have to pay lots of dollars to settle the liability. Lots of dollars to settle the liability because euro appreciated. So in this case, since yen appreciated, when yen was translated in or converted into dollars, you received lots of dollars. But when euro appreciated, you have to give so many dollars to settle the liability. For this reason, there is a loss. Now, the question I am going to ask, which of these options is correct? The exchange rates are expressed as so many units of foreign currency to $1. So the way we express is that it's yen per dollar and euro per dollar. This is the exchange rate we express. Did the number of foreign currency units exchangeable for dollar increase or decrease between the contract and the settlement date? That's what you need to think over. The trick is, we know for sure that yen appreciated against dollar, that's why you received lots of dollars. And euro appreciated against dollar, that's why we had to pay lots of dollars. So both currency appreciated. What does it mean? The question says yen changeable per dollar. Since yen has appreciated, euro has appreciated. So when you will translate these dollars into yen, you will receive lesser yens. You will receive lesser euros because your currency is weak. Consider the Pakistani currency is getting a beating. We have to pay more and more rupees to buy euros, more and more rupees to buy pounds and dollars. Since dollars are weak here in this case, so dollars will get you less yen. Dollars will get you less euros. Look at this specific information. Yen exchangeable for $1. $1 will get you less yens because dollars is weak. $1 will get you less euros because dollar is weak. That's the point. So B is the answer. B is the answer. If anyone has any confusion, please do ask. So it's B. Let's move on to the next question. Which of the following statements is most accurate regarding enterprise risk management? Most accurate. Let us see. It is required by SEC to be put in place for all public companies. Absolutely incorrect. Enterprise COSO ERM does not have any legal force. It is totally your choice. It's up to you whether you want to adopt COSO ERM or you don't. They provide you thought leadership. They do not have the force of the law. So this is clearly incorrect. The purpose of framework is to help organization eliminate risk. We don't want to eliminate risk. Sometimes we deliberately look for risk because risk and return, they are correlated. We take some risk, result in high return. Sometimes businesses deliberately take risk, a balanced risk to increase return. Incorrect. It was developed prior to internal control integrated framework. Wrong. First integrated internal control was given to us later, 12 years later, COSO ERM was introduced. So COSO came after internal control framework. The internal control cube, I'm sure you would know from section E part 1. So it aids management in balancing risk with the need to increase return. We want to balance risk and return. Both are desirable. We want to take return, more return, yes, then take some risk. So we need to balance them some way. Take some risk as well as make gains, make earnings. That's the idea. Okay. Again, there are 5 responses to risk. You khali wali the risk, you mitigate the risk, you transfer or share the risk with your vendor, supplier, banker, insurance company. You accept the risk called self-insurance, and you sometimes deliberately exploit risk. This is called risk seeking. Let's see. Able Corporation owns numerous businesses along the coast of Florida. This time question is different. The company's management has identified business interruption events as potential risk resulting from storm damage caused by hurricanes. Management is so fearful of the possibility of storm damage that it elects to divest. See, divest means khali wali. That means avoidance, sell off. Please mind this. These are interrelated concepts. Sell off, divest, avoid. Yes. So divest the company of virtually all properties to Florida cost, sell it to someone else. Able response to potential risk is risk avoidance. Absolutely correct. Now this is an unlikely question because you will be required to calculate IRR, and invariably the questions you see on the exam for calculation of IRR will have the consistent cash flows. Either it is 6666 throughout or it's going to be 888. Most of the questions are like that. But if we are, let's say, in the worst case scenario, we have to do questions like these. What you do? If you add all these cash flows, 6, 6, 12, 8, 28. So it's 28 inflows in the 4 years, 20 outflow. So the gap is only 8,000 in undiscounted cash flows. 40 is too high, 5 is too low. So it could be anything between 12 and 14. So I'm going to tell you how to tackle a question like this. You have the present value table with you on your exam. You can always call it by pressing the PV table button on the screen. The question is that if we have to go for trying these IRR numbers one by one, what you will do, take 6,000. There are 2 6,000 and 2 8,000. And what you do, you have the discount numbers with you. First you take the 12% discount factor for first year, second year, third year and fourth year. You write the discount factor for first year 12%, second year 12%, third year 12%, 12%. When you multiply 6,000 first year discount plus 6,000 second year discount factor plus 8, and the totaling of this will give you approximately 20,918. We need exact 20,000 or close to it. Using 18% second rate, 14% in all these discount factor numbers, 6,000 multiplied by discount factor 14% year 1 plus 6,000 discount factor 14% year 2 plus 8,000 into discount factor for year 3 and 4. Adding these will give you approximately 20,016, which means the present value of cash flows in both cases, this is closer to the initial investment, and we know IRR is that rate at which the present value of inflows is equal to your initial investment or present value of outflow. So this number 20,016 is closer to 20,000, and this IRR clearly is than 14%. Let's say if you don't want to go for this long calculation, A and D are not possible, go for a calculated guess with a 50% probability of getting the right answer. But I recommend that this is the way you can use hit and error. Just 2% can be tried. You can find IRR this way. Most of the question on your exam will have a single inflow, and using single inflows, it is very easy to calculate IRR. How do you do it? Let me show you. Let's say if these are 8,000, 8,000, 8,000, all these numbers are the same. How do you find IRR in this case? Please remember, I just told you, PV of inflow is equal to your initial investment. This is how we find IRR. You have 4 inflows of 8,000 multiplied with the annuity factor of 4 for a certain interest rate we don't know. You make annuity factor for 4 years at a certain rate as a subject. You divide 20,000 with 8,000. 20,000 with 8,000 will give you 2.5. Now what you do, you go to the present value table, and let me take you there. I need to look for 2.5 in the 4th year row. I need to look the number, the percentage I find is the estimate IRR. Let us go there. So we want to find the IRR, and in the 4th year row, we need to find 2.5, 2.5, 2.5, 2.5. This is the present value, $1. We need to look for present value of an annuity. This is where you will find. This is for a single dollar. And this is the present value of an annuity. This is what we should be looking for. And if you... the 4th year row, you will find 2.5, nearly at 20%. So somewhere, so you will see this 2.5, or maybe next number will be even lower. So the percentage that is very close to 2.5, so this is your IRR. These are the kind of questions you see on your exam. So this is the way you would find IRR using your present value tables. Okay, so what do we have here? This question apparently looks long. I always recommend you guys to read the specific requirement. Ignoring taxes, the cost relevant to decision to produce or not to produce a certain product. So you're talking about the relevant cash flows. Relevant cash flows. Okay, capital company has decided to discontinue a product produced on machine purchased 4 years ago at this cost. This cost has already been paid. It's a sunk cost, irrelevant. We just need the relevant cost or relevant cash flows. The machine has a current book value of 30,000. Due to technologically improved machinery now available in the marketplace, the existing machine has no current salvage value. The company is reviewing the various aspects involved in the production of new product. The engineering staff advised that the existing machine can be used to produce new product. But this machine currently has no relevant cost. What is relevant? Other costs involved in the production of the new product will material of 20,000. This is what we would need. Yes, Zishan, you're absolutely right. And the labor for this particular product. So these two costs are your relevant costs. So that makes A to be the correct option. And A is the right answer. Which of the following methodologies of price determination starts with the estimating product costs? So clearly relating to pricing, target costing starts with the target selling price. Let's say I want to sell a certain item at $30. This is the target selling price. And I want to make a target profit of 30% of the selling price. 30% of 30, that is $9. Which means if 30 is the price that which I want to sell, 9 is the desired profit. I must produce this at 21. This is called the target cost. The question is, which of the following methodologies of price determination starts with estimating product cost and then adding a desired level of income? You take cost first and you add a certain profit percentage, cost plus profit percentage. It is B without doubt. It is B because it starts from cost, add profits. Target costing starts from selling price and end up at cost. So it's not the answer. In life cycle costing, you add up all the costs on a product starting from its inception design, called the downstream upstream cost plus manufacturing plus downstream cost. So it involves taking all the costs over the life of the product from its initiation till the point when it is taken out from the market. So basically, Khizr, the question is, which of the following methodology of price determination start with estimating product costs? When you say product costs, you are specifically talking about the manufacturing cost, which could be the full absorption cost or which could be the variable cost, sometimes called direct costing, right? Unless the words specifically say the whole life cost or the life cycle cost, product cost involves three things: direct material, direct labor, and the manufacturing overhead, which can be split into fixed and variable. So this is the reason. This is not the answer. And activity-based costing, gentlemen, is section B, CMA part 1. D, involving the cost allocation techniques. It's not a pricing methodology. So for doubt, we got B to be the correct option. Okay, so what do we have here? A comparatively bigger question. What is the cost of carrying additional investment in account receivable? The key point here to note is that if I sell goods worth $100,000 to my customers, this is not my investment in my account receivable, because this is the amount due from him, and some part of it is profit and some part of it involves fixed cost. My concern is only the variable cost part of this amount. This is my relevant point. Only the variable cost in the account receivable, that is relevant in decision making. Variable cost component of the amount due from customers, that is what I consider in decision making. Fixed cost in the short run is irrelevant. Profit is irrelevant. I need to make sure that variable costs are covered. So this is what we are looking for. Okay, it says Guardshore Incorporated is a mail order book company. The company recently changed its credit policy in an attempt to increase sales. Guardshore variable cost ratio is 70%, variable cost percentage is 70%, and it is required rate of return is 12%. Okay, the company projects that annual sales will increase from current level of $360,000 to $432,000, but the average collection period on receivables will go down or will go up from 30 days to 40 days. Ignoring any tax implication, what is the cost of carrying the additional investments in receivables? First, we will find the account receivable balance under both schemes, and then we will take only 70% that amount because that is what is relevant. Profit and fixed cost in that price is irrelevant for us in decision making. For this, we will go make use of the formula called average collection period. It is equal to average receivable over credit sales or whatever sales times 360. Why 360? The question says so. If I rearrange this formula and make account receivable as your subject of the equation, is going to be AR is equal to average collection period multiplied by sales over 360. This will help me calculate account receivable under the new arrangements, people. So if I plug in average collection period 30, sales to be 360 divided by 360, it gives me $30,000. Same thing here, average collection period is 40, sales in this case is 432,000 upon 360. If you simplify all this, it gives you $48,000. So my extra or additional receivables is $18,000. It includes fixed cost and profit. I am interested only in what is invested in short term. What is invested in my account receivable in the short term is just variable cost only at the rate of 70%. So this is my investment, extra investment in receivables, 18,000 times 70%, that is 12,600. This is my investment in extra receivable. Had I put this money in some profitable investments, had I put this money at 12%, what was the cost? This question didn't ask you what is the extra receivable. Look at the beauty of this question. It says, what is the cost of carrying the additional investment in receivable? If the question asks, what is the extra receivable? This is the answer. You click D, you go home. But that's a wrong thing. You need to be very careful and highlight, because there is a highlighting option in the exam. You can highlight the specific part of the question. So you're always mindful of what is required. Cost of carrying additional investment. This is the additional investment. But what is the cost of additional investment? Multiply this with the opportunity cost of fund, that's 12%. So 12,600 times 12% gives you 1512. That is the answer. This is the cost of carrying extra receivables, and these are the extra receivables, 18,000 on the variable cost basis. So people, A is the answer. Alright, so what do we have next? This question involves pricing, little twisted question. A company produces and sells electric boilers and reported the following information for the year just ended. These many units produced. This is the investment, markup percentage on full cost, return on investment, and the variable cost. Interesting. The question says, using the cost plus target rate of return method, the selling price per unit will be. We have been given the markup percentage on full cost. We have been given rate of return on investment, 20%. Our rate of return or our profit is 20% of investment. Okay, let us first calculate what is our profit. So profit is equal to 20% on investment, 20% of $3 million, which comes out to be $600,000 in total. We need to find the selling price per unit. So what is the profit per unit? Let's say profit per unit is equal to $600,000 divided by units involved. This gives you $400. So your profit per unit is $400. In order to find the selling price, we must find the cost. Cost plus profit will give you the selling price. So how do we do this? This is the second part. It says markup percentage on full cost is 10%. Your profit is 10% of full cost. 10% of full cost is equal to your profit. Profit we have just calculated as 400. 10% of full cost, which means full cost is equal to 400 divided by 10%, that is 4,000. And we know the selling price is equal to fixed cost sorry, selling price is equal to your full cost, not fixed cost, plus profit. Full cost is 4,000, profit is 400. That means the selling price is 4,400. That makes D to be the correct option. Okay, what do we have next? Again, a bigger question involving pricing. A company currently sells 10,000 units of its product for 40 per unit when the variable cost ratio was 40%. Market research conducted by the marketing department shows that if the company offers 10% markdown, reduces the price by 10% on selling prices, its sales volume will increase by 30%. Okay, right now we are selling 10,000 units. If we reduce our price, our number of units sold will go up by 30%. That means 13,000 units will be sold. Okay. What is the expected effect on implementing the markdown policy on the total contribution margin? Interesting question. If we do not change our selling price, which is basically $40 per unit, so our sales revenue, 40 times 10, $400,000, and if we reduce our price by 10%, that means it's going to be 36, right? 13,000 into 36, that will give you 468,000. Here the selling price is 40. Here the selling price is reduced by 10% to 36. Implementing this change will raise your units sold from 10 to 13, 30% higher. Okay. Next, we need to deduct variable cost. It said variable cost is 40% of selling price. 40% of 40, 40% of 40, that is $16 per unit. So if it is $16 per unit, so 16 multiplied by 10,000, 160, and 16 multiplied by 13,000, 208. I'm sure all of you know sales minus variable cost is your contribution. 400 less 160, that is 240, and 468 less 28, 260. So if you implement this change, lowering the selling price will overall increase your profit by 20,000, and that makes A to be the correct option. Next, Bar company has total debt of 420, stockholders equity of $700,000. Okay, Bar is seeking capital to fund an expansion. Bar is planning to issue an additional 300,000 in common equity, which will raise the equity figure from 700 to 700 plus 3, $1 million. Your new equity balance will be $100,000. And it is negotiating with the bank to borrow additional funding for loan. Of course, from bank you borrow money, loan. The bank is requiring a debt to equity ratio of 0.75. We want to issue shares, this much. This will be the new balance of equity. We want to take loan also, but bank says, okay, I will give you the loan, but your debt to equity must not be less than 0.75. This is the number you should carry. This should be the maximum debt to equity ratio. So debt to equity is 0.75. Equity is 1 million, which means the maximum debt you can raise is 1 million times 0.75. It's $750,000. This is the debt ceiling. You should not take your debt more than this. Otherwise, debt to equity ratio will go up. This is the maximum debt ceiling put by the bank. You already have a debt of 420. The question says, what is the maximum additional debt you can take from the bank? Already debt is 420. This is the maximum ceiling. So the difference between what you can and what you have is the additional amount of $330,000. This is the additional debt you can take from the bank and still be able to meet this debt to equity ratio put by the bank. That makes B to be the correct option. Next, which of the following terms represent a group of the firms colluding to make price and output? Let us discuss each one. Cartel, OPEC, Saudi Arabia, Venezuela, Russia, all are a part of cartel. What is a cartel? Group of producers who under an arrangement try to restrict production and try to agree what the price each will charge. So which of the following terms represent a group of firms colluding to make a price and output decision? It is a cartel. Correct. An oligopoly is a market structure where few firms operate and they control the whole market. The example is cement industry in many countries, steel business, banks, they are all oligopoly, few firms controlling the whole market. Price leadership, on the other hand, is a situation where a single firm has the market power to lead the market in which it operates, and concentrated market power means a market which is controlled by just one or few firms. In case of one, it is called monopoly. In case of few, it is called oligopoly. Right? So that is not what we're looking for. We're looking for cartel, where a group of firms combine each other, collude with each other to restrict production and set certain price. Patents are granted in order to encourage firms to invest in research and development of new products. You develop an engine design, you get it patented with a patent registration authority in the US. No one can copy that design. You have a medicine formula, you don't want others to copy it. You get your formula patented by the authority, you get protection for 10 to 15 years. So what do patents represent? Patents are market concentration. Market concentration is basically the extent to which firms dominate, certain firms dominate in a market. This is not what we're looking for. Yes, it's a barrier to entry. In pharmaceutical industry, few firms have patents of COVID-19. So it means others cannot enter because patent is a barrier to entry. No one can copy it. So this is correct. B is the answer. Then we have exclusionary practices. This is an interesting concept. Basically, these are the tactics by powerful firms, dominant firms, to limit competition or keep the smaller firms under control or exclude them from competition altogether. And collusion, we have already discussed. This is where firms collude in a cartel to restrict the price and output. Okay. Look for the questions requirement. Price earning ratio. Immediately the formula that should spring up in your mind is price to earning ratio, that is the market price per share over earning per share. And we need to look for these two. At the year end, Appleseed company reported a net income of 588,000. Fine. The company has 10,000 shares of 100 par value, 6% preferred stock, and 120 shares of 10 par value common stock. 5,000 shares are in treasury. There are no dividends payments in arrears, and the market price of the common stock is 40. That is what we needed. We do not have EPS, so we need to find EPS. What is EPS? That is IACS. IACS is the income available to common stockholders, which is equal to net income minus preferred stock dividend, whether paid or not. If they are cumulative, whether declared or paid or not, must be deducted upon the weighted average number of shares. So your net income is given as 588. Your preferred stock dividend can be calculated by taking this 10,000 shares of 100 each, and each share gets 6% dividend. So multiplying this will give you 1,006%, that is $60,000. And what is the number of shares outstanding? Common stock 120. So net income minus preferred stock dividend upon 120 gives you 4.4. This 4.4 is in the denominator, so 40 over 4.4 gives you approximately 9.09, and that's the answer. Why we did not consider treasury stock? The reason: treasury stock are our own stock which we have purchased from the market for many reasons. Maybe we would like to give these shares as stock dividend, maybe we would like to give these shares as an employee share option plan, or maybe we just want to get rid of extra shares circulating in the market. Treasury shares are not entitled to any dividend. Treasury shares are not entitled to any voting rights. Treasury shares are dormant shares. They are not included in any ratio calculation because they are dead stock with the company for certain specific reason. IACS, when you calculate IACS, that is by definition net income minus preferred stock dividend, right? Because we want to calculate income, because EPS is based upon the common stock. So you have to take the income that is attributable to the common stock right? And you cannot pay dividend to the common stockholder unless you pay dividend to the preferred stockholders. For this reason, whenever you calculate IACS, you have to consider the preferred stock dividend. Once they are paid, only then what is left is what belongs to the common stockholders, and based upon it we calculate the EPS. That was an important point to consider, gentlemen, ladies. Next beautiful question involves Forex, future markets. There are 4 types of derivatives in your syllabus: options, swaps, forwards and futures. And here you have a question related to futures. Let's see what it says. On September 30th, year 1, cable company entered into a short position. This is something important. You have to distinguish between short and long position. When you are having a short position, it means you have agreed to sell in derivatives. I'm not talking about the long position or short position with regard to a certain underlying. We're talking about short position, long position with regard to a derivative. So when you have taken a short position in future context, it means you have agreed to sell the underlying. If you have taken the long position, it means you have agreed to buy. Please note it down somewhere, it will be helpful for future context. Agreed to buy. So what is the case here? Cable company entered into a short position in the future context, and it explains here to sell 50,000 euros or 50,000 pounds at this rate. So you have locked yourself in this rate in a future market, 1.25 euros per pound. Okay. It says on December 31st, year 1, the spot rate was 1.3, whereas this is the rate at which you agree to sell. This is the rate prevalent in the market. As a result of this change in exchange rate, is there gain or loss in this short position? Let us see. You have to sell 50,000 pounds at this rate, whereas the market price is more attractive. You could have sold at 1.3 euros per pound. You would have got more euros, but since you have to net off your position, so it means what you're going to give, 50,000 to 1.25, you are going to give 62,500 euros versus 50,000 into 1.3, that is 65,000 euros. So the difference between what you gave and what you could have got from the market is 2,500 euro based loss. So that is basically option D. We have a question here. Alright, so what do we have in this question? We need to find out the weighted annual interest rate for trade credit, that is the cost of not taking discount. CyberEdge Outlet, a relatively new store, is a cafe that offers customers the opportunity to browse the internet or play computer games at their tables while they drink coffee. The customer pays a fee based on the amount of time signed onto the computer. The store also sells books, T-shirts, computer accessories. CyberEdge has been paying all of its bills on the last day of the payment period, means it is giving up discounts, forfeiting all the suppliers' discounts. Shown below are data on CyberEdge's 2 major vendors, including average monthly purchases and credit terms. There are 2 vendors, Webmaster. Our average monthly purchase is 25,000. This vendor gives us the credit terms 210 net 30. If the payment is made within 10 days, 2% off. Otherwise, no discount, pay within 30 days. Second supplier vendor is SoftID or SoftID. Average purchase monthly 50,000. Very nice credit terms. 5% discount if the payment is made within 10 days, else the full amount to be paid at the end of 90th day. Assuming a 360-day year and that the CyberEdge continues paying on the last day of the credit, last day, that is 30th day on Webmaster and 90th day on SoftID, what is the company's weighted annual interest rate for trade credit for these 2 vendors? That is the cost of not taking discount, weighted average. First of all, you need to know the formula. Cost of not taking discount, we calculate this using the formula. Discount percentage over 100 minus discount percentage into 360 days as per the question, minus payment period minus discount period. So if you just look at the total average purchase from both is 75, And if you calculate the weights, we need to calculate on weighted average basis. So 25, 50, total 75. This gives Webmaster a total weight of 33.33%. And for Softidy, it is about 66.67%. So this is the weight given to them. Let us calculate for both of these the cost of not taking discount. Let us calculate first for Webmaster. 210, 2 over 100 minus 2 into 360. Payment period for Webmaster, it is 30 days. Discount period is 10 days. If you calculate this, cost of not taking discount for Softidy, it is 36.73%. Okay. You do the same for this was for Webmaster. We do the same for Softidy. It is going to be 5% over 100 minus 5% into 360 divided by the payment period 90, discount period 10. If you simplify this, this will give you the cost of not taking discount, which is 23.68. It's relatively straightforward now. Relatively straightforward. So we have two vendors, Webmaster, Softidy. Weightage is 33.33% to W, Webmaster, and 66.67 to the second vendor. The cost of not taking discount is 36.73% for Webmaster and 23.68 for Softidy. If you take the weighted average, multiply these percentages and add them up, the combined answer is going to be 28.03%, which perfectly matches with your option B. This is the weighted average cost for not taking discount. Okay, a comparatively bigger question, I always recommend whenever you come across the larger questions, you need to see what exactly is required. The unit selling price to achieve the target profit. There are certain range of formulas you may be required to use. This is a CVP based question. General formula, when you just have to find the break-even quantity. Break-even quantity is fixed cost over unit contribution margin. But when you need to not only cover your fixed cost, also you need to make some operating profit. In that case, formula is revised to this fixed cost plus target operating profit divided by the unit contribution margin. But sometimes you are required to calculate certain net profit where the tax rate is also going to look at this. The after tax profit, this is what we want, the target net profit. Then the formula needs little revision. Fixed cost plus net profit or net income over 1 minus tax rate divided by unit contribution margin. These are the three versions of the formula depending upon what is required. Since the net income is involved in this question, so we are going to use this formula. We just need to find these four missing numbers: fixed costs, net income, UCM, we can solve. Delphi company has developed a new product that will be marketed for the first time during the next fiscal year. Although the marketing department estimates 35,000 units could be sold at this price, Delphi management has allocated only enough manufacturing capacity to produce a maximum of 25,000 units. We can't sell or produce more than 25. This is the maximum limit on our quantity. Next, the fixed cost associated with the new product and budgeted for $450,000. Fixed cost is $450,000, which includes $60,000 of depreciation on new manufacturing equipment, which is related for this particular project. So $450,000 is the fixed cost including depreciation. It's not a cash flow. Depreciation is a cost to be considered in break-even analysis. So do not think that depreciation is ignored in CVP analysis. It is a part of the analysis because it relates to the project, a specific situation. Data associated with each unit of product are presented below. Delphi tax rate is 40%. 1 minus tax rate is 40%. Direct material, direct labor, variable overheads, variable selling, total variable cost is 16. Question says Delphi company's management has stipulated that it will not approve the continued manufacturing of the new product after the next fiscal year unless the after-tax profit is at least 75,000. This is what we need. So for this, the unit selling price to achieve this target, what the selling price should be in order to achieve this net profit target. We know unit contribution margin is equal to sales price minus all the variable costs. Right? So we can replace UCM with sales minus variable cost. Sales prices we need to calculate. Variable cost is given. So in the denominator, in place of UCM, we can write S minus 16. Try to simplify. It's a very simple arithmetic. Doesn't involve too much of maths. 450 plus 75,000 upon 1 minus 40%. In other words, 75,000 divided by 60%. It gives you 125,000 over sales minus 16. What you can do next, take sales minus 16, S minus 16 to the numerator, bring 25,000 in the denominator. 450 plus 125 is 575,000, which eventually simplifies to 23. So the equation is now much simplified. S minus 16 is equal to 23, which means selling price has to be 23 plus 16, 39, in order to achieve this much target profit. So please note down these formulas. They will be available in the videos also. So you can solve many questions involving unit contribution margin, just break-even point, or the quantity you need to sell in order to achieve this much operating profit. And this version is when the net income is requested. This is a very useful formula. Do not go for any equation formation. Just use these formulas, plug in the right numbers, and you will get the right answer. Next. What happened here? Canine Industries anticipates investment in equipment designed to improve the efficiency of its operations. The company anticipates that the investment will generate 10,000 in revenues. 10,000 in revenues, good. In addition to producing annual cost saving of $40,000. So you have 10,000 revenues as well as 40,000 annual cost saving. So I'm going to get this 10,000 revenue and this 40,000 as cost savings every year. If the tax rate applicable to the company is 25%, what are the anticipated after-tax cash flows of this investment? This revenue 10,000 before tax, on after-tax basis, if you just take 60% of this number or just multiply it with 1 minus 40%, in any case, it is 6,000 here. And you should also, since it's a cost, you should also take it on after-tax basis. Or in other words, what you can do, simply combine these two. 10,000 revenue is a benefit. 40,000 cost saving is also a benefit. So basically, it is a total of 50,000. From this 50,000 of benefit, revenue as well as cost saving, deduct tax at the rate of not 40%, sorry, 25%. So 25% of 50,000 is 12,500. So the net benefit you get after tax is 37,500. You will get the same stuff from here. Take 75% of this number, take 75 of this, addition will give you the same number. Any way you want to do, this is the anticipated after tax cash flows from this investment. Revenues after tax and cost saving after tax. So that will give you D to be the correct option. Okay, next question is an interesting one. It says a company requires that the capital budgeting proposal meet the acceptability criteria of both the payback method and the net present value. It has to have a positive NPV. The company uses a cut-off payback period of 4 years. The project should pay off within 4 years. So these are the two criteria must be met simultaneously. Which of the following projects would produce conflicting results when applying both payback and NPV? When we need to take both. Now, payback method, look at this. The very first project gives you a most attractive net present value. If you go for NPV, which is the most superior method, the project is rejected by the payback method because it is 5 years. We need a project to return within 3 years. This is totally unacceptable. For both cases, negative NPV and 5 years beyond. If you take these two within the NPV but payback period, but the NPV is very little, this is the project A which will cause conflict. NPV highly attractive, payback unattractive. So the project A is the one that will cause the highest level of conflict. Rest of these are not as important compared to A. So A will cause conflict. NPV says yes. Payback says no, despite being a very attractive project with 800,000 return. Okay, this is a good question involving multi-product. How do you deal multi-product questions? Specialty Cakes Incorporated produces two types of cakes, 2 pounds round cake and a 3-pound heart-shaped cake like this. Now, it says total fixed cost is $94,000. Variable cost and sales data for the two types of cakes are presented below. We have selling price 12, variable cost 8, that means contribution is $4. Heart-shaped says a selling price of 20, variable cost 15, that is UCM is $5, contribution $5. Existing sales proportion 10 and 15 means that the total 25,000, of which 10,000 cakes are round, which is 40%, and 15,000 is heart-shaped, that is 60. How did I calculate? 10 plus 15, 25. 10 by 25, 40%, 15 by 20 was 60. Relative proportion. Okay. If the product sales mix, which right now is 40-60, were to change to 3 heart shapes for each round cake, we sell total 4 cake, out of which 3 are heart shaped, 1 is round cake. That means 75% heart shaped and 25% are going to be round shaped. The break-even volume for each of these products would be, the first step you should do is to calculate the weighted average contribution margin. Round cake has a weight of 25% and the contribution is $4. Heart shape under the new arrangement has a weight of 75% and the contribution of 5. If we calculate the weighted average contribution margin, it's $4.75 per cake. Next step is to calculate the break-even quantity. Break-even quantity is equal to fixed cost divided by weighted average contribution margin. Fixed cost is given as $94,000. Weighted average contribution margin is 4.75, which means the break-even quantity comes out to be approximately 19,790. Now, this 19,790, if broken down in the proportion of 25% and 75%, because that is the sales mix, 25% of 19,790 gives you 4947. 4947 and 75% heart shape gives you 14,842, which is a perfect match for your option C. So know your formulas and extract the information carefully, plug the info in the formulas, and there you go. Forex. On December 1st, year 2, Cruise Corporation purchased supplies from Anchor Limited, an unaffiliated foreign company, for 5,000 euros. On that date, the spot rate was 0.90. Let us list down, there are certain dates. First, we have 1st of December, year 2. It's a good question. When we entered into a contract to purchase certain goods costing 5,000 euros, at that date, on this date, the rate was $0.90 per euro. 1 euro was equal to 0.9. If on that date 5,000 euros were involved, 5,000 times 0.9, it means the liability we booked in dollar terms was $4,500. That is what represented AP on this particular date. Okay, so on the date of the balance sheet, we have to be very careful. On December 31st, year 2, December 31st, year 2, the rate was on December 31st, year 2, the spot rate was $1.02 per euro. So at this rate, $1.02 per euro, it means the liability would increase to $5,100. Clearly, because euro strengthened. When euro will strengthen, you will have to pay more dollars. This is clearly evident from here. This is the balance sheet end. Liability hasn't yet been settled, but that's the balance sheet end. What happens further? When the transaction is settled, when it is settled on 1st of February, year 3, when we settled at that time, the rate was $0.95 per euro. So the settlement date, 5,000 euros at the rate of 0.95, it fell to 4750. Alright, now what is the whole story? Originally, this was the original liability, 4,500 was the original reported liability. On the balance sheet date, the liability rose to 5,100, so we wrote off a loss of $600 as a transaction loss at the end of the balance sheet on 31st of December year 2. This is a loss. Year is closed. Next year, this 41500, which was the amount of liability to be paid, but it was settled on 1st January year 3 for 4750. 4750 was paid against our liability 5100, indicating a $350 gain. Now this gain, $350, this gain will be reported when? Look at the question's requirement. This question is specifically twisted at the end. We are done till this point. What amount of foreign currency transaction gain or loss is reported on cruise income statement for the year ended December 31st year 3? December 31st year 3. This is the loss reported December 31st year 2. This income which was generated, because liability was 51, we settled for 4750, $350 gain. This gain will be reported at the end of 31st December year 3. This is specifically what is needed, and this is what is reported as a gain. So A, 350 is the answer. Powell Industry deals with customers throughout the country, and it is attempting to more efficiently collect its account receivables. A major bank has offered to develop and operate a lockbox system for Powell at a cost of $90,000 per year. This is the cost, $90,000 per annum. Okay. Powell averages 300 receipts per day. This is the daily collection of checks, and each amounts 2,500. That means that our daily collection is about 300 times 2,500, that is $750,000. This is what we collect on daily basis in checks, right? Its short-term interest cost is 8% per year. This is what we could earn on excess cash balance. Using a 360-day year, what reduction in average collection time would be needed in order to justify the lockbox system? Bank is asking for $90,000 per annum cost. If this lockbox system can generate us a benefit of at least $90,000, then at least it is justified. The cost of this lockbox system is offset by the benefit generated by this lockbox system. So our benefit has to be at least 90,000. Only things will make work. So let us make an equation here. Our benefit must be equal to the cost in order to make this acceptable to us. Cost is $90,000. Says what should be the reduction in average collection time? What you call the reduction in float. Call it certain days D. D days will be reduced by this new lockbox system. Our average collection period amount on daily basis is $750,000. Now, if it is reduced by 2 days, you get 1.5 million. 4 days, you get 3 million. What is the number of days of surplus balance if invested at 8% interest on a yearly basis? How much should be the reduction by days? What is the days reduced that the benefit generated in excess cash is offset by the cost of this lockbox system? This is the benefit. Average cash balance times 8% is the annual benefit. This is the annual cost. So equating this, days is equal to $90,000 divided by $750,000 over 8%. If you simplify, it comes out to be 1.5 days. At least the reduction in collection time should be 1.5 days. If it is at least 1.5 days, our cost is offset by the benefit generated. If it is more than 1.5, amazing, it will generate net benefit. But if it is less than 1.5, then this option is not worth it. So right now, 1.5 is the break-even time. If it is higher, great, we will make a net benefit. If it is lower, then it is a loss. Alright, next question, theoretical. Which of the following statements is most accurate regarding event identification within the enterprise risk management? Most accurate. The political environment is primarily internal event. No, it is external. Technology is often both internal and an external event. That is right. Technology can be a risk. It can be an opportunity. It can be internal, it can be external. This is correct statement. What about C? Positive events are more critical to the organization than negative events. Wrong. Positive events results in opportunities. Negative events result in risk. Both are equally critical. Both can be equally critical, so this is not right. What about D? The negative event is a risk. It doesn't represent a potential opportunity. Remember, a positive event results in potential opportunity. A negative event results in risk. And we have to take care of both of them because both can be critical for the success of the business. Negative event results into a risk and a positive event results in a potential opportunity. So this is clearly mismatched. So we got the answer. This was right. B. Next question involves section E, investment decision analysis. Let us see what do we have here. Something is missing here. An equipment will cost $250,000. This is the cost of the equipment. Installation and transportation cost $25,000. So that means the cost of the equipment including installation, which basically to be capitalized, it is $275,000. This is the cost of the equipment. The appropriate 5-year depreciation schedule, 20% depreciation in the first year, second year, third year, fourth year and fifth year. These are the depreciation rates given under the tax laws, modified accelerated cost recovery systems, MACRS. So these are the rates we will use, will be employed with no terminal value factored into computation, mean the book value will be 0 at the end of 5 years. Okay. Annual incremental pre-tax cash inflows are estimated to be $75,000. Cash flows every year will be $75,000. Skype effective income tax rate is Skytop's effective income tax rate is 40%. Okay. Assuming machine is sold at the end of the year for $30,000, disposal value is $30,000 at the end of the year. What is the after-tax cash flow for year 5 the project would consider? So we just need the, not for 1, year 2, 3 or 4, we just need for the 5th year cash flow. Let us see one by one. First and foremost, our $75,000 annual cash flows, which we receive every year 1, 2, 3, 4, 5 as well. So this must be considered in year 5, but after tax. So a quick way of doing it, to convert this cash flow into after tax, multiply it with the factor 1 minus tax rate, or simply 1 minus 40%, that is 60%. 75,000, 60% is $45,000. This is the first inflow. Done. Then this asset which has a cost of $275,000, it will be depreciated by this percentage in the 5th year. 275 multiplied by 14.5%. This will give you the depreciation charge in the 5th year, which is 14.5% of the cost, 275,000. 39875. This is depreciation expense. Under the tax laws, this depreciation expense will attract depreciation tax shield at the rate of 40%. This is depreciation expense. Depreciation is a valid tax deductible expense, attracts depreciation tax shield. What is depreciation tax shield? It's the reduction in your tax payable. It is calculated by multiplying your depreciation expense with the tax rate. So multiply it with the 44% figure, it's 15,950. This is also an inflow because it is a reduction in your tax payable because of depreciation's tax deductibility. Done. What else? We sell a machine for $30,000 whereas the book value is 0. This $30,000 is the whole gain. All of it is gain because book value is 0. Disposal value is $30,000. Whole of it is gain, which is taxable at the rate of 40%. So out of this total amount received, 30,000, 40%, 12,000 is tax payable, which means the net amount 18,000 is the after-tax proceeds of this disposal. If you add this 45, 15.95 and 18, it gives you the total 78,950 cash flows at the 5th year, and that will make D to be the correct option. A US company is paying for goods purchased in British pounds. All of the following exchange rate movements will give rise to a gain except, again, a US company, dollar-based economy, they have purchased something for which they have to pay British pounds to accounts payable. All of the following exchange rate movements will give rise to a gain except, let us see one by one. The US dollar appreciates or appreciating versus the pound. When the dollar becomes stronger, that strong dollar will give you so many pounds, so it will be much easier for you to settle the liability. Dollar is strong, pound becomes weaker, so that is a win situation for you. Or conversely speaking, dollar appreciates or pound depreciates against US dollar. They are both the same. It's just like looking at a picture from both sides. US dollar appreciate against pound or pound depreciates against US dollar. They mean the same. So this situation is same for A and B. What about C? When more pounds are needed to purchase 1 US dollar, you need so many pounds to purchase 1 US dollar. That means the same, the dollar is strong. So many pounds go into purchasing dollar. So this is again good. Dollar, whenever dollar is good, your currency is strong, so it will be easier for you to make foreign payments to your suppliers. So again, this is a win-win situation for you. What happens in D? This is it. When more US dollars are needed to purchase 1 pound, you need more dollars. And these more dollars get you a bigger pound. That's where the problem is. You have to pay more dollars to buy pounds to settle the liability, and that's where you incur a loss, and that's why D is the answer. D is the answer. Next, we have a cash flow related question, and it's a good question, needs full attention, full focus. Ironside Products is considering 2 independent projects, each requiring cash outlay of $500,000 and having an expected life of 10 years. The forecasted annual net cash inflows for each project R and S, and the probability distribution for these cash flows are as follows. A very good question. Please pay special attention to this question. All right. Ironside has decided that the project with the greater relative risk should meet a hurdle rate of 16%, and a project with less risk should meet a hurdle rate of 12%. Given these parameters, which of the following actions should be remembered for Ironside? Now you people decide. 12% is for the project that has less risk and 16% for the project that has more risk. How would you distinguish between R and S? Which one is riskier, which one has less risk? Think about it and tell me. Look at the cash distribution of project S. Standard deviation is a measure we use to calculate the variability. But since standard deviation calculation is not a part of your syllabus, you just need to know what is standard deviation. But what you see here is the deviation of cash inflows is diverse here. But here it looks like 90% of the cash flows are between 95 to 115. So this project S has more variability of cash flows than the project R. For this reason, project S must be discounted at 16% and project R must be discounted at 12%. This is the first point. Now the next step is, since we have to have the NPV, the cash flow every year, so that's why we have to first calculate the EVs. 0.25 times 70,000, 0.5 times 110, 0.25 times 150. If you multiply these probabilities with the cash flows, the expected value of cash flow for project S comes out to be $110,000. We do the same with project R. 10% of 75, 80% of 95, 10% of 115. it gives us an expected cash flow every year of $95,000. Now let us analyze these one by one. Let us take first project R, which must be discounted at 12%. How do we calculate NPV? NPV of the project is equal to annual cash inflows. We have $95,000 every year multiplied by annuity factor for 12% for 10 years minus initial investment of $500,000. So annuity factor for 12% for 10 years, it is 5.65. 5.65 multiplied by 95,000 minus 500,000, it gives me a positive number of 36,750. This is for project R. You do the same for project S, whereby every year inflow is 110, annuity factor at the rate of 16% for 12 years minus initial investment, which is same for both. So 110 times annuity factor for 16% will definitely be lower than this, because higher percentage means a lower annuity factor. It is going to be 4.833 minus 500,000. So this project will generate an NPV of 31,630. So based upon since both of these projects generate a positive NPV, in fact the options are missing unfortunately. What was required? Let me see the requirement. Which of the following actions should be recommended for Ironside stay? Since these projects are independent projects mean both can be taken if they have positive NPVs. Both of them have positive NPV, so the correct option accept both projects. Had the word been used mutually exclusive, which means either R or S, in that case we would have taken R, because for the same initial investment R is generating a higher NPV. So I would have gone for R had they been mutually exclusive. Since they are independent, and independent projects means you can take all of them if you have enough fulus. If you have fulus and there are independent projects, take them both. That's the right option. We will take them both, and unfortunately the option is hidden here. I don't know why. This is a very good question involving your inventory management. Very good question indeed. Please read this very well. Valley Incorporated uses 400 pounds of a rare isotope per year. The isotope costs $500 per pound, but the supplier is offering a quantity discount of 2% for order size between 30 and 79, and a 6% discount if the order size is above 80 pounds or more. The ordering costs are $200 per order. Carrying costs are $100 per pound of material and are not affected by the discounts. Carrying cost is dependent upon the material quantity, not price, not discount. If the purchasing manager places 8 orders of 50 pounds each, means he is agreeing to give away the discount, and it doesn't go above 80 pounds per order. He is buying within this bracket. Then what is the total cost of ordering and carrying cost and the discounts lost? Wonderful question. So we have to find the total cost, ordering cost, carrying cost and discount lost, because you are buying a less quantity and you are giving up the discount. Please follow. Since the manager has decided to place the order size of 50 pounds per order and the annual requirement is 400, we need to find out how many number of orders do we place. Since 400 pounds are needed, 400 divided by 50, that means we need 8 orders every year. Each order costs us $200. The ordering costs are $200 per order. 8 orders at the rate of 200 each, that means the ordering cost is $600. Okay. Next is the carrying cost. For carrying cost, you have to calculate the average inventory, and please write down this formula. It is not written anywhere, but it's very useful. Average inventory is equal to order size divided by 2 plus any safety stock if given in the question. First step is in calculating the carrying cost is first to calculate the average inventory, that is order size over 2 plus safety stock. Our order size every time is 50 pounds. So 50 pounds upon 2, There is no safety stock, so it means our average inventory is 25. Average stock is 25. And how do we calculate the carrying cost? Carrying cost is equal to average inventory, 25, and cost to carry each pound is 100. So 25 pounds, and the cost to carry average inventory is $100 per pound. So that means your carrying cost is $2,500. Last, the quantity discount lost. Remember, 2% discount you are already getting within this bracket. If you order above 80 pounds per order, you will get 6% discount. So how much discount you are losing? You are already getting 2. You could have got 6. Discount lost is 4%. This is the discount lost in percentage. How much you would have saved? Every year you buy 400, and cost per pound of this isotope is $500. So 4% times 400 times $500 per pound gives you $8,000 of discount lost. Adding these three, 8,000 discount lost, 2,500 cost of carrying inventory, and 1,600 is the ordering cost. Combining these will give you 12,100 as the total cost of ordering, carrying, and the quantity discount lost. A good question to be done a couple of times to grasp the idea involving inventory. Next. A foreign subsidiary functional currency is its local currency. Euro, let's say. You are in Germany and the functional currency is euro. That is the local currency, which has not experienced significant inflation. The weighted average exchange rate for the current year would be appropriate exchange rate for translating. Mind it. Remember, the income statement items are for the whole period starting from 1st Jan to 31st December, for example. So many transactions of sale, purchase, many expenses are paid throughout the year. Right? So when the translation is made of income statement into the parent company financial statements, income statement items are translated on weighted average. Why? Because the transactions occurred throughout the year. We can't take a particular rate, year end or year start. A weighted average rate is suitable. Whereas the balance sheet items, we take a rate prevalent on the balance sheet date. Right now, what we have, salary expense, which is an income statement item, sales to external customer, which is also an income statement item. Since they are income statement items, so we will take weighted average for translation. So the point is, which of these two items will be translated at the weighted average rate? Sales expense, salaries expense, and sales to external customers, both income statement items, to be translated at the weighted average rate is the answer. Next. Which of the following pricing methods focuses on setting the price based on recouping the manufacturing cost? Recouping means recovering the manufacturing cost. Whatever you have incurred, you want to recover it. So what pricing you will use? Clearly cost plus. Whatever you have incurred as a cost, you want to recover the cost. So take whatever the cost is, add a certain markup of your choice, and then select the selling price. So this is most appropriate when you want to recover your manufacturing cost and achieving a desired profit. So take cost, add a certain markup. And of course, rest of these are inappropriate in the given situation. Okay, again, comparatively a sizable question. Let us read. Cater Company is a manufacturer of industrial components. One of this product that is used as a sub-component in auto manufacturing is KB96. This product has the following financial structure: selling price, direct material, direct labor, variable manufacturing overheads, fixed manufacturing per unit, shipping and handling, fixed selling, and we got the total cost of the product. Okay. During the next year, KB96 sales are expected to be 10,000 units. All of these costs will remain the same, except fixed manufacturing cost, which will increase by 20%, and the material cost, which will increase by 10%. The selling price per unit will be 160 instead of 150. Based on this data, the contribution margin, please remember, contribution margin is sales minus all. Specific focus and emphasis on all. variable cost. All variable cost means selling, variable admin, direct material, direct labor, variable overhead. These are the 5 variable costs which must be deducted from sales in order to find the contribution. So first thing is that your selling price is going to go up to 160. Your material cost is going to go up by 10%, 20 is 10%, 2 plus 20, 22. Direct labor 15. Variable manufacturing 12. Fixed is ignored. Shipping and handling is variable 3. So you need to deduct all the variable cost which is given. So 160 less 22, 15, 12 and 3 gives you 108. This is the unit contribution. And since you are going to sell 10,000 units, so 108 unit contribution margin or contribution per unit multiplied by the expected unit sale will give you $1.08 million, and that's what we need. See, we conveniently ignored the fixed cost because question specifically said contribution, so we ignored the change in fixed cost completely. So that is the answer, 1.08 million. Next question, and again it involves Forex transactions, and let's see carefully what we are supposed to do. The Johns Corporation, a US company with a calendar year, and enters into a transaction to purchase goods from Japanese company for 800,000 yen. Okay, the transaction occurred on April 20th and was settled on May 20th. The exchange rate on April 20th was 80 yen per dollar, but the exchange rate on settlement date was 82. Right? What are we supposed to do? The April journal entry, we just have to show the journal entry for first part. Second is not needed, but we will do for the sake of understanding. So what happened? 800,000 yen translated at this rate. How do we convert? 80 yen are equal to $1. So 800,000 yen will be equal to $10,000. So the entry you're going to make is you're going to debit purchase with $10,000 and credit your accounts payable with $10,000. How did I calculate? Simple. The rate is 80 yen per dollar. $1 is equal to 80 yen. Since 800,000 yens are involved, so 800,000 upon 80, $10,000. Right? This is the entry, and you get your answer. The journal entry on 20th of on April shows a debit to purchase 976. No, a debit to purchase for 10, credit to accounts payable of 10. That is the answer. That is the answer for the question. Let's say had it asked us how the transaction was settled on May 20th. Follow. You have your account payable which is $10,000, but when it was settled at that date, yen appreciated. Did yen appreciate or depreciate? First you have to decide. It was $80, 80 yen per dollar. Now it is 82 yen per dollar. Now tell me which currency appreciated. This is the key question. First, $1 got you 80. Now $1 gets you 82 yen. That means dollar appreciated and yen depreciated. Which means our liability, which was $10,000, will be lowered. And how do we calculate this? Same way. You will divide 800,000 yens with 82, and the new liability to be settled in dollars is 9756. So the entry you make, this is not needed in the question, but just for the sake of understanding, we are going to debit our accounts payable with 10, but we only make the payment from our bank of $9,756. The difference between what we had to pay and what we actually pay, this difference of $244 is your Forex transaction gain. This is not needed, but we have calculated it. So for now, this was the only required part. Credit to accounts payable for $10,000. B is the answer. Okay, now this is the question. This requires understanding of the dividend discount model. I hope you would remember the cost of equity can be calculated using dividend discount model using two versions of the formula. One is D1 upon the current market price plus growth rate, right? This D1 is the next dividend, market price of the share, G is the growth rate. If you are given the current dividend, which is called D0, D0 into 1 plus G over current market price plus growth rate. right? You are absolutely right. We can use the CAPM also for the required rate of return, that is risk-free rate plus beta times return on the market minus risk-free rates. These are the two versions. The three elements needed to estimate the cost of equity capital for using in determining the firm's weighted average cost of capital. Let us see which of these fits the bill. Current dividend per share, expected growth rate, and the current market price, all pointing toward the dividend discount, Gordon-Brock model. Current earning per share, no such thing. Current earning per share, current dividend per share, expected growth rate, and current market price per current dividend per share makes sense. Expected growth rate in dividends per share. Now we are in a pickle. A and D are in close conflict with each other. A and D are in close conflict. Let us clean this thing up so you can better judge which of these is the right option. All right. Current dividend per share, yes. Current dividend per share, yes. Expected growth rate in earning per share. Expected growth rate in dividend per share. And current market price per share, yes. What we have here, G, it is the expected growth rate in dividends. This was the key point which may have been overlooked. Earning per share, dividend per share. Dividend discount model, G assumes a certain percentage increase in dividends. So this makes D to be the correct option. So that's why you have to read the options very carefully. Sometimes we might get bogged down and get the incorrect option. This is a good question. Which of the following derivative instruments essentially provide a downside protection? Downside protection means that protects you in case the price falls. You purchase a call option to purchase a certain stock at $50. Purchase a call option. Call options mean the right to purchase at 50. If the market price falls to 40, you will simply go and buy the share in the market. So you will allow the option to fall. So this call option is not protecting you against downside protection. It benefits only when the price goes up. If the price of the stock goes up to 80, you will be able to buy at 50. So this is incorrect. Interest rate swaps is not a tool we use for downside protection. Yes, that is purchase of a put option. Put options gives you the right to sell an asset at a strike price 50, let's say. If the market price of the stock falls, you will be protected against this downside risk. By this put option, you can still sell a stock at 50, the market price of which may have fallen to $30. This is absolutely right. You got it correctly. And currency future contracts, there is no downside protection with this type of instrument as well. This is a fairly straightforward question. When you have to calculate IRR, average rate of return, payback or NPV, which of these four methods involve discounting cash flows? Internal rate of return, it uses discounting cash flows, yet it does. Average rate of return, which is no longer a part of your syllabus anymore, it was before 2015. It involves just accounting profit and average book value of the assets. No discounting. Payback requires no discounting. Discounted payback does, but simple payback doesn't. Net present value does. So that means yes, no, no, yes. That makes D to be the correct option. So it was a fairly straightforward question. You should expect such questions. Okay, 49. Arbor Corporation is evaluating its working capital financing, which is a short-term need. Management is concerned about increasing interest rates. Interest rate may go up, and management has elected to fund its working capital with an equity loan from a Harbor National Bank by collateralizing land. What is equity loan? Anybody? Let's say you have a property. Collateral is there, but equity. Let me explain the idea, Ayush. Let's say you have land. The market value of this land is $1 million. And this land is under a mortgage. So market value is $1 million and you owe to a financial institution $600,000 loan on this land. There is already a loan on this piece of land. Since market value is more, the loan which you have to pay is less. The difference between these $400,000 is your equity. It belongs to you. Since there is still a positive equity because market value is more, loan amount on this property is less, you can still take this $400,000 as equity and use it as a collateral to take further loan. This is called equity loan. Bank will give you loan again on the same property which is already under debt. So we have decided to use this piece of land and use it as an equity loan from a bank. The Arbors Corporation decision is most likely designed to minimize what? First, you may decide, most of you may say it's interest rate risk. No, this is not interest rate risk. Interest rate risk involves when you have made an investment in certain bonds or certain interest sensitive investments. Changes in the valuation of your investment because of interest rate fluctuation. Your investment value changes. This is called interest rate risk. Changes in the value of your investment, fixed income investment, because of changes in the interest rate is called the interest rate risk. This is not it. Market risk is the risk that every business faces, which is a non-diversifiable or undiversifiable risk. This is the risk that emerges from the economy, the overall political situation. Default risk is the risk that you face as if you have issued a bond, or you have purchased a bond and the company from whom you have purchased the bond, it doesn't pay the interest. So it's the creditor's exposure to non-payment. This is a credit risk. Since the interest rates are rising, so the company finds it hard to receive loans. Maybe when the interest rate rise, there will be a credit crisis. So despite we have a short-term need of money, we are going for long-term funding, basically taking a piece of land and taking a loaner. It's a long-term arrangement, but we want to protect ourselves against the credit risk. Credit risk is unavailability of credit when we need it because interest rates are higher, right? So for this, company wants to protect itself against the credit risk. Next, Danforth Corporation circuit production plant has 10,000 units capacity and currently produces 10,000 circuit boards. It means the capacity is fully utilized. Capacity is fully utilized. There is no spare capacity. The company incurs $50,000 in variable costs. Variable cost is $50,000 and its current production and carries $40,000 fixed cost. 40,000 fixed cost. Danforth has explored other alternatives and knows that the next best alternative would be produce 2,000 contribution margin for 1,000 unit run. This is what we could earn as a use of alternative facility. If Danforth has an opportunity to fill a special order of 1,000 unit circuits, the price per unit that they should charge. First of all, they should recover their variable cost. Fixed cost is irrelevant in the short run. They should cover this $50,000 of variable cost which is incurred on 10,000 units. That is on per unit basis. It is a $5. So this cover their variable cost per unit $5. And since there is a loss contribution, $2,000 contribution can be earned by producing 1,000 units. That means $2 is the lost opportunity. So if any special order comes, absolutely you need to recover your variable cost as well as loss contribution. So that will give you C to be the correct option. Next, this question again involves CVP analysis. As I said that you will use the standardized formula. Let's see which formula version is needed. Novel Creation wants to achieve an after-tax profit of this for the year ended December 31st, year 1. The company sells its products for $35 per unit and has a contribution margin ratio of 15%. The company's fixed costs are $150,000. Tax is $25,000. How many units must be sold to achieve this after-tax profit? I told you the formula. The target quantity is equal to the fixed cost plus net income over 1 minus tax rates. Very useful formula, divided by unit contribution margin. So we have the fixed cost given right here as $150,000. We have the desired net profit of $45,000. Tax rate is 1 minus 25%. UCM can be calculated. Contribution margin ratio is 15%. 15% of what? 15% of selling price. And selling price happens to be 35. So 15% of 35 means 5.25. So it means your unit contribution margin is $5.25. 15% of selling price. This will serve as a denominator of this arrangement. Numerator, if simplified, gives you 150 plus 45, 60%, 60,000. So it gives you 150 plus 60,000 divided by 5.25, and there you go. Straight question, just plug in the right numbers and you will always get the right answer. 40, C is the answer. CVP, I think, is the easiest area. If you know the formulas and using the right formula in the right situation, you will get it correctly. Okay, which of the following is a debt instrument that generally has the maturity of 10 years or more? A very straightforward question. Clearly it is bond. Bonds have maturities greater than 10 years. Notes payables are typically short-term obligations and their maturity is less than 10 years. Chattel mortgage, these are notes collateralized by movable personal property. They are again of less than 10 years maturity. And financial lease, operating lease, I'm sure you've done in your part 1 section A, external financial reporting. Normally it is also less than 10 years. So bonds are the instruments which have maturity of more than 10 years. Fairly straightforward question. We do have some bond valuation questions and we'll do when and where they fall. Using COSO enterprise risk management integrated framework as a basis for dealing with uncertainty while seeking profit and growth. We need to deal with uncertainty, but still we want to make some profit. What the organization should do? Avoid all risks? Wrong. All risks cannot be avoided. Only few can be. Then develop a strategy in a manner that aligns with management's risk appetite. That makes much more sense. A strategy that aligns with the risk appetite, how much risk the management is willing to take, make much sense. The organization would only set entity-wide strategy goals. This is again wrong because ERM considers all layers of the organization at entity level, not at strategic level. And the organization would eliminate uncertainty. Wrong. Uncertainty cannot be eliminated. Enterprise risk management, it will only help you to reduce uncertainty. You cannot eliminate uncertainty. This is again a Forex related question. Let's see. Atlas Worldwide Industries conducts business in a number of different countries and is trying to evaluate its economic exposure to exchange rate risk. Which of the following statements is not correct? Which of the following is not correct? Atlas will suffer an economic loss in the event it has net cash outflow. You have to pay dollars and dollars appreciate, like what we are seeing in Pakistan. When dollar appreciates, we have to make payment in dollars. We are in trouble. This is a true statement. It is true. If you have to make a payment and the foreign currency appreciates, you are in trouble. B. Atlas will enjoy an economic gain in the event that it has net cash outflow and foreign currency depreciates. This is true also. You have to make dollar payments and dollar depreciates, you will gain. This is true. This is the table from the lectures. Those who have studied Forex with us, they would know. Atlas will suffer an economic loss in the event it has net cash inflow and foreign currency appreciates. This is wrong. If you have to receive dollars and dollars appreciate, resultantly you will receive so many rupees that will make you rich. So if you are expecting cash inflows in foreign currency and foreign currency appreciates, you gain, not lose. This is the incorrect option. And then it says Atlas will suffer an economic loss in the event it has net cash inflow and foreign currency depreciates. What do you say about this? This is true also. You need to receive dollars, dollar depreciate, you will receive fewer rupees. So these two also. So be very careful when you're doing questions like these, because we are looking for an incorrect option. A, B, D are correct and C was incorrect, and that is what we were supposed to identify. Alright. Okay, this is a good question, but before we do this, we need to construct some scheduling first, some diagrams, then we will explain. Alright. Supply, demand, I'm sure I don't need to write. All of you know. So this is the demand supply diagram. Which of the following statements about supply and demand is true? Let us see one by one. This is A, this is B, this is C, this is D. If the supply increases, let me also point out that these are the original quantities and price level. This is quantity QE, price E, QE. Just for the sake of explanation, normally it's not needed, you can just guess, but if supply increases, this is the supply curve. If the supply increases and demand remains constant, if supply increases and demand remains constant, equilibrium price will rise. Wrong. You can see equilibrium price is falling. So this is incorrect. If demand increases and supply also increases, equilibrium quantity will fall. Wrong. Equilibrium quantity is increasing. This is incorrect as well. If the demand increases and supply decreases, equilibrium price will increase. Yes. You can see the equilibrium price goes up. Yes, that is correct option. This is correct. Why not D? If the demand increases, this is the increase in demand, and supply remains constant, equilibrium price will fall. No, you can see equilibrium price is increasing. So this is incorrect as well. So doing the question this way, by constructing demand supply diagram, will be much easier for you guys. So that makes C to be the correct option. Okay, what do we have here? It is a question involving section E, investment decision analysis. Core Industries is analyzing a capital investment proposal for the new equipment to produce a product over the next 8 years. Okay. The analyst is attempting to determine the appropriate end of life cash flows for the analysis. So we are talking about the cash flows involving 8th year. At the end of the 8th year, the equipment must be removed from the plant and will have a net book value of 0, a tax basis of 75, a cost to remove 40, a scrap salvage value of 10, and tax rate of 40. There are many numbers. Let me highlight the numbers and then we'll go about. This is the tax basis of the asset. Cost of removal is 40, scrap value is 10, tax rate is 40. We have to calculate what is the end of life cash flows. Let us discuss this one by one. When you dispose of this asset, it had a book value of $75,000, right? It's a loss. This loss will attract a tax benefit. Remember, you pay taxes on gains and you get benefit on losses and expenses, right? Cost of removing is 40,000, which is clearly an outflow. Since it's a cost, you will get a tax benefit. You get tax benefit on expenses and losses, but you pay taxes on gains and incomes. That's a basic idea of taxation. So let us first see this cost to remove. This is what you pay. Yes, you pay 40,000 to remove the machine from ground, decommissioning cost. Since it's an expense, it will attract tax saving at the rate of 40%. 40% of 40,000, this is the tax saving on this expense. I write it as plus. Then, this scrap value of $10,000 is what you receive as an inflow. Yes, I do. But this 10,000 inflow is taxable. It is taxable because whole of it is gain. So it's going to be a 40% number. 40%, that is 4,000. tax on this gain is payable. Similarly, you receive benefit on expense, tax on gain. And this 75,000 tax basis is eventually being reduced to 0. This 0 versus 75,000, the whole of it represents a tax loss which will attract a tax saving of 40%. 75,000 of 40%, that will give you $30,000, a benefit. If you add all these 30, then you have 40, 16 plus, 10 plus, 4,000 negative. The net inflow would be $12,000, which nicely matches with your option B. So this is a more elaborate way of doing things. Take the cash flow separately and see their tax impacts. Otherwise, you can take the numbers net of tax. That is a quicker way, but totally up to you, whichever method you feel comfortable with. Okay, next question involves, we have a company that has a certain item to sell at this price: direct material, labor, variable overhead, fixed, variable selling, fixed selling, total cost, and that's the operating profit. What is needed? The company received a special order for 1,000 units of a product. The company currently has excess capacity but has an alternative use of this capacity that will result in a contribution of $20,000. This is the opportunity cost. If we shift to a special order, we will give up this. So this is what we must recover. What is the minimum price that the company should charge for this special order? First of all, take on all your variable costs. Take 40 material, labor, variable manufacturing, variable selling. They are very important. Take them all. Take them all. Further, this loss contribution on this special order, $1,000, 1,000 units, divide this loss contribution with units of the special order. You must receive $20 on each unit for the loss contribution. So I'm going to highlight the numbers you need to consider: material, labor, variable overhead per unit, variable selling per unit, and lost contribution per unit 20. All these highlighted numbers must be added, and they will give you the minimum selling price at which you should sell. So the minimum selling price for this project should be for this special offer is 120, because this price covers the cost of manufacturing and allows companies to break even, because this is the price that no profit, no loss, at least whatever you are incurring, whatever you are sacrificing, that is at least recovered. Absolutely right. Okay, next. Both the current ratio and the quick ratio of a Spartan corporation have slowly decreasing over the years. For the past 2 years, the current ratio has been 2.3 to 1 and 2.0 to 1. During the same time, the quick ratio, also called the acid test ratio, it has been 1.2 to 1 to 1 to 1. This disparity between current and quick ratio, quite a significant difference between the current and quick ratio, can be explained by which of the following. I hope you would remember, current ratio and quick ratio, they differ because of the two inputs. One, inventory, other, prepayments. In quick ratio, we do not consider inventory and prepayments, but in current ratio, we do consider all the current assets. So because of these two variables, why there is a difference between current and quick ratio, quite a large difference. So is it because of which of these? You need to look for these two elements, because these are the differences between current and quick ratio. So inventory balance is unusually high. When you remove your inventory balance, your current ratio immediately falls to a lower number for quick ratio, and this is the reason why there is quite a massive gap between current and quick ratios. Next. So what is the answer? D. Okay, you may be required to calculate the price elasticity of demand. The recommended formula you should use for calculating PED, it is the change in quantity demanded, Q2 minus Q1 over Q1 plus Q2, divided by change in price, that is P2 minus P1 over P1 plus P2. You may ignore these signs, negative or plus, but this is the formula you should use as per your syllabus recommendation. If the result in absolute terms, if it is greater than 0, then the price is elastic, the product is price elastic, price relatively inelastic, unity elastic, right? If it is equal to 1. So it says the Jacobs Incorporated raises sales price of its only product from 50 to 60. Sale price goes up from 50 to 60, that is 60 minus 50 over 50 plus 60, or you may write it as 60 plus 50. Okay. And it has resulted in change in quantity from quantity 80 to 60. Quantity has changed from 80 to 60, so write it 80 minus 60 over 80 plus 60. Forget about the order because we are going to ignore the negative sign. If you simplify this all, that is 20 over 140 and then you have 10 over 110, the final answer will be 1.57. So it means whatever the item is being discussed, it is relatively price elastic. This range shows price elastic, relatively inelastic, and unitary elastic. Okay, what else? The term beta can be best described as what? I'm sure you would know from the capital asset pricing model, KE, or the required rate of return, it is equal to risk-free rate plus beta, return on the market minus risk-free rate. What is beta basically? Variability or standard deviation of investment returns? No. Beta is not variability of investment returns. Beta measures the sensitivity of investment to changes in the market return. If the market returns change, the asset returns will change. So how your returns correlate with the market returns, this is what is measured by beta. Investment returns sensitivity to changes in the market returns, that is what is the measure of beta, and it's one of the components of the capital asset pricing model.